Hello everyone, welcome back to Current Economy, and of course we're going to have a follow-up show about your money, but thanks for staying with us. We have been on the air. Both Paul is our co-host from Ameriprise Financial and myself, I'm Ron Jankowski with Channel 4 and Palos Heights. We haven't been on the air since March, I guess it's been, so it's been a long time. We're going to start out a little differently today, and we'll gradually get back to our normal format. And Paul is going to share a lot of information that he has picked up from Ameriprise. And Ameriprise has also given me some current information for today that we just received and I have in front of me. So what we're going to do is turn this over to Paul and let Paul take it from there. Paul, if you have anything that you want me to interact on, you let me know.
Okay, great. I'm going today, in the first half of the show, talk about the jobs numbers that we did receive in the market last week. And the truth of it is about 25 million jobs have been lost during the pandemic, not the often cited 47 million that we just realized. A cumulative count of weekly unemployment claims is no longer a legitimate measure of pandemic period job losses, but not everyone has gotten that message. Early in the pandemic period, approximately late March through the end of April, a cumulative count of new unemployment claims was a good approximation of the jobs lost due to the outbreak. People that lost their job were very likely to sign up for unemployment benefits, and it was very likely that people were hired as to offset those job losses. As soon as businesses started to call back or rehire employees when allowed, is when the cumulative method lost its value. The reason is simple. Unemployment claims only reflect one side of the equation, jobs lost. The Labor Department's monthly employment report, however, is a net number, job losses and job gains. So unfortunately, the cumulative method caught on in those early weeks of the pandemic and is still being used in some areas. After last week's claims report, it was easy to find more than one headline proclaiming total job losses are now up to 47 million. And again, according to the points I'm laying out, very misleading. In our view at Ameriprise, the actual number of jobs lost during the pandemic is somewhere between 22 and 25 million. This is still, of course, a horrific number, especially over the course of just a few months, but it's almost half of the number oftentimes cited. The numbers represent the changes in total employment from the peak in February to the new low that was created back in April, as reported by the Labor Department's monthly establishment and household employment surveys, respectively. So just something to be aware of out there. Things are bad when it comes to employment. There is no denying it, but potentially, given the points I laid out, maybe not as bad as you're hearing about.
And also I want to mention, Paul, that there's so much uncertainty at this point with so many things going on. As we get this, we'll share this with the viewers, but expect things to change in 24 hours very easily with the market change up and down. The market was up just before we went on the air around 400 plus on the Dow, and 30 minutes prior to that it was like 300, so it shot up over 100 and some points over. So, but anyway, I'm going to share with you the information that we also received from Ameriprise Financial as of this morning. The S&P 500 futures are indicating 0.5% higher near the best levels of the morning following a drawdown last week on rising COVID-19 case data. The yield on the 10-year Treasury is slightly higher ahead of Wednesday's release of the June FOMC meeting minutes.
And before you go on with yields where they are, if you haven't looked at your mortgage rates recently, it might be a good time to take a look at them and potentially think about refinancing, because rates have dropped for lending purposes.
Significantly. I'm glad you brought that up. In fact, I noticed yesterday some banks are as low as 2.9,
Wow.
30-year mortgage.
That's very, very, very low.
Unbelievable.
Yep.
Yeah, it really is. And of course, they hover now between 3% or so, give or take a point or two, but tenth of a percent. But anyway, yes, a good point that you did bring up. Stocks in Asia closed lower across the board, led by Japan's Nikkei, losing 2.3%. European markets are mostly higher, led by the FTSE 100, up 0.7%. And interesting enough, shares of Boeing are higher. Pre-market following reports that 737 MAX flights are set to resume.
Investors in that stock have seen a lot of volatility over the course of the past year. That stock was continually rising and then got floored last year and into this year with everything going on. So that's a bit of good news for Boeing investors. So far, a bit of a recovery today.
It's nice to know that this is going on because there's a lot of inventory of planes sitting,
Yep.
waiting to be certified to be flown again.
Well, and they're waiting for people to want to be flown around too.
Well, that's the other thing.
Yeah.
Even though they put them on the inventory to fly, will one want to get on that plane?
Right.
I want to mention also the year-to-date numbers for the S&P 500 is down 5.94%. The Dow Jones is down 11.26%, and the NASDAQ is a plus 9.35%.
Those aren't horrible numbers. I mean, we were much, much lower if you look back to March of this year, but still down on the year in the S&P and the Dow. We just were so used to those big gains we got last year that this probably feels a lot worse than it is. This is not a significant loss for the indexes, historically speaking, down about 6% in the S&P and 11 in the Dow.
Yeah. Okay, well, we are going to close for the current economy. That's the information we have at this point. As I had mentioned, there's so much uncertainty. We will feed that information to you as we get it, and we will come back to you next week, Monday, with the current report. But we want to go into our next phase, talking about your money. Stay with us. We'll be right back. And we're back with your money. Thanks for staying with us. And again, as I had mentioned previously, Paul Munichel from Enterprise is co-hosting with me, and he has a topic talking about emotions at this point in time with all the things that are going on. Paul, you have some information you want to share with us and some guidance.
Yep, I've got some prepared words here that I'd like to give to the viewers at home because it's exactly what's going on now. People are very emotional with the volatility in the market, and I'm here to hopefully fan that flame down a bit for people. So here we go. It is important to maintain a level head in times of market turbulence, but that's often easier said than done, especially in the heat of market volatility. Even with the best intentions, investors can be challenged by their own bias and emotions when it comes to making investment decisions. Emotional investing may be amplified during periods of market stress. By understanding your emotions and biases, you can better avoid common pitfalls and keep yourself on track to reach your financial goals. Some of the common investment biases that we see are overconfidence when markets are going high, aversion to loss when we start to see volatility turn to the downside, anchoring, which we'll talk about a little later in the show, and pattern-seeking behavior. So let's start with overconfidence. Overconfidence simply implies that investors tend to overestimate their ability to generate a return and underestimate the risk associated with a particular investment. So let's look at an example. Imagine you are an investor who has recently had success picking some winning stocks. You may conclude that the success is solely due to your investment skill, and that may be the case. But it is also possible the results were due to market forces outside of your control. And the problem is that in either case, recent success may encourage you to take greater risks, While this could lead to greater profits, it's just as likely to result in greater losses. Herding mentality, which is the tendency for investors to follow and copy other investors, also tends to distort near-term risks in up markets. Thus, investors can maintain, they can't maintain the discount, the volatility, and chance for loss they seek to chase higher returns. Investors are best served by the following objective information and building in an expectation that stocks do not move in a straight line. Let's talk about aversion to loss. Aversion to loss is something that everyone has inside of them. It's said that one feels the pain of loss twice as strongly as the joy of a gain. In an attempt to minimize the pain associated with an investment loss, investors may be more prone to take action that can lead to the derailment of their long-term investment success. In market drawdowns, investors can be quick to react, selling stocks and over-allocating to bonds or cash to avoid future losses and protect their nest eggs. Many investors sold down their stock funds in favor of bond funds during the crash of the market in 2008 and 2009. Unfortunately, some of these investors missed out on the subsequent rally that eventually took place right after and helped propel stocks to all-time new highs. While it's tempting to move to the sidelines during times of market stress, investors may want to avoid over-allocating to cash and avoid locking in investment losses that they would not otherwise have made if the market wasn't reacting volatilely. Importantly enough, if people maintain a well-diversified investment mix and own high-quality stocks and bonds, you should be able to stomach the near-term investment losses and ride out eventual market cycles that come and go with time. And that's all assuming that you are invested in the appropriate mix of stocks and bonds due to your risk tolerance and to reach your goals. Finally, let's talk about that anchoring a little bit. Anchoring implies that investors tend to rely too heavily on specific information or lean on recent circumstances to make decisions. Our minds can tend to anchor to information, and it is used as a reference point moving forward, regardless of relevancy. For example, investors may hang on to poor investments by waiting for them to break even at the price for which it was originally purchased. If you're trying to decide whether to sell or hold a stock, you are basing your decision on what you know about the company and the state of the market, or are you basing your target price based on your purchase price or other measures that may be less relevant to the stock's future course? To help combat such biases, it's important that investors accept the market circumstances routinely change and sometimes suddenly. Therefore, your outlook may need to change accordingly. Investors can adjust to new market developments by seeking objective information, leaning on a financial advisor for sound advice, and setting realistic expectations for potential returns. And last but not least, I want to talk about pattern-seeking behavior. And that often describes our brain's desire to seek out ways to compartmentalize the flow of information and patterns that help make sense of the world quickly. Since our brain is hardwired to do this, investors can mistakenly believe they see patterns in market trends that prove to be false. Since the future can be unpredictable at times and patterns not always present, investors may want to incorporate the following bullet points in summary. 1. Establish realistic expectations for your portfolio, both from a return and risk perspective. 2. Expect markets to move in unpredictable ways, particularly during periods of market stress. 3. While the near term is unpredictable, generally stocks move up and to the right over the long term. And point 4, society is aging and growth is slower, that means the patterns of the past may be harder to apply to the future, or possibly not even relevant in the same way. To truly understand your risk tolerance and your threshold for loss can go a long way in helping you maintain a level head during times of market stress. If you suspect your personal investing bias and emotions are interfering with your investment decisions, defer to the experts. Ask a financial professional to conduct an objective review of your portfolio with an eye to performance and your financial goals. Together, you can look for opportunities to grow your investments through disciplined investing, time-tested strategies.
Any more today, unless you're a seasoned investor for many, many years and have experienced the market ups and downs, you should have an investment advisor and discuss it with them what you should be doing to achieve your objectives.
Exactly. I mean, especially in what we've just experienced. Last year, we were basically going straight up in the market for the most part. This year, we started out great in January and February, and then March and April hit, and the market sold off very quickly, and then it's starting to recover very quickly. So it would have been very easy to get whipsawed in that environment and sell at the wrong time or buy at the wrong time. Plus, just because we've started to recover now, that doesn't mean something else could happen this year that can drive the markets lower again. So there's never a white flag that's waved and then all clear that it's time, it's safe to invest again. There's always going to be volatility, and you can't predict it.
Right. You can't predict it even when the market is going well.
No, it's very, very difficult, if not impossible,
right.
to consistently. You can get it right once or twice or three, but to consistently predict market volatility and time it right, very difficult, if not impossible to do.
Well, that's our show for today on Your Money. Thank you, Paul, from Paul Municles with Ameriprise Financial. And Paul, why don't you give your ID so that in case one would have a question, they could call you.
Absolutely. I am a financial advisor. I am located in the area. Whether you're working with someone and are looking for potentially a second opinion, or if you're doing it by yourself and want to discuss options with me, give me a call directly. I'm at 708-226-3412.
Again, for Paul Municle with Ameriprise Financial and myself, Ron Jankowski with Channel 4 and Palos Heights, we wish you good investment day.